Welcome to The Explainer. If you're a college freshman, or honestly just someone stepping into the business world for the very first time, I'm about to completely flip how you think about accounting. We're going to take it from this dreaded, intimidating math subject and turn it into what it actually is, an incredibly powerful, strategic communication tool.
Look, let's just bust this massive myth right out of the gate, okay? Accounting, it is not a math class. We're not doing complex calculus or searching for unknown variables here. It's actually an information system. It's the way we interpret and tell a company's financial story. People call it the language of business, and today we're going to get you speaking it. To get you completely fluent, here's our roadmap. We'll cover the language of business. Step 1, the measurement process. Step 2, communicating the story, the conceptual framework, and finally, 4 fundamental assumptions. Let's get to it.
So why does learning this language actually matter? Well, take a look at Tesla. For years, their sales were climbing, right? But investors only really started driving the stock price to the moon when the accounting information finally showed a true profit in 2020. That financial story literally moved the entire market.
Part 1. The language of business. Translating chaos into strategy.
Before we translate a single thing, we gotta know who we're translating for. At its absolute core, this language exists for one reason: to help people make solid, confident decisions. Whether you're an investor deciding to buy stock, a bank figuring out if they should lend money, or a manager planning a huge expansion, you're relying on accountants. They take the chaotic day-to-day mess of running a business and distill it down into clear, actionable insights. It really acts as a continuous loop. Accountants measure what the business is doing, they communicate that data to the decision makers, and then those decisions, like say investing $1 million into a new factory, spark brand new business activities. It is this constant, ongoing cycle of measuring and communicating. Part 2. Step 1. The measurement process, or creating the record. All right, let's get into the very first major phase of translating, stepping in and actually recording what the company is doing. If you're just starting out in your business degree, take a deep breath because the entire discipline of accounting basically boils down to just 2 distinct steps. First, we measure the messy reality. Second, we communicate it clearly to the world. That's it. The absolute most crucial part of measuring is identifying our core elements. And the big one is our assets. Think of assets as simply the actual resources the company holds to provide its goods or services. We're talking cash in the bank, delivery vans, office buildings, or even just the right to collect money from customers later on. Next, we have to balance those resources against who actually has a claim to them. If the company owes money to outside creditors, like a massive bank loan or a stack of unpaid supplier bills, we call those liabilities. But if the claims belong to the internal owners and investors, that is what we call stockholders' equity. And those 3 elements, they build the fundamental rule of the entire game, the ultimate accounting equation. Assets equal liabilities plus stockholders' equity, meaning every single resource a company has is perfectly balanced by the claims against it. It is just such a beautifully logical system. Moving right along to part 3, step 2, communicating the story and distributing the translation. Okay. So once we've measured the business and balanced our equation, we got to package that translation up for the outside world, right? We do this through financial statements. Without these reports, folks on the outside, like lenders or potential stockholders, would be completely blind to what's happening inside the company. They desperately need these statements to answer massive questions, like, is this company actually making money? Or can they even pay back this loan?
And hey, this is definitely not just busy work. When you take raw economic activity and apply real critical thinking to it, you generate genuinely useful information. That info leads to smart decisions by investors, which efficiently allocates resources across the economy, and ultimately, it builds a more prosperous society for all of us. You're doing incredibly vital work here.
Part 4. The rulebook, the conceptual framework governing the translation. Now think about this. If every single accountant just translated business activities however they felt like it, the financial markets would be absolute chaos. That is exactly why we rely on the conceptual framework. It's a theoretical rulebook created by the Financial Accounting Standards Board. You can think of it like the U.S. Constitution, but for accounting. It's a benchmark that guarantees an accountant in New York and an accountant in L.A. are interpreting business activities the exact same way.
For financial information to actually be useful to someone making a decision, it has to pass a few tests in this rulebook. The two absolute biggest hurdles are relevance, meaning the information actually matters to the decision being made, and faithful representation, meaning the numbers accurately, completely, and neutrally reflect what really happened in the real world.
Finally, Part 5. 4 Fundamental Accounting Assumptions, the true foundation of the rules.
To actually apply all these rules in the real world, the whole system rests on 4 foundational assumptions. Honestly, as a freshman just getting started, mastering these 4 concepts is going to be your secret weapon. We have to make these assumptions before we can write a single report. They are the absolute bedrock that allows generally accepted accounting principles, or GAAP, to even exist. Let's break them down real quick.
First up is the economic entity assumption. This just means we have to draw a strict boundary around the business itself. So if you're doing the accounting for Nike, the massive personal mansion of Nike's co-founder Phil Knight cannot be mixed up and reported as an asset of the Nike Corporation. The business is its own completely distinct entity.
Next is the monetary unit assumption. We absolutely need a universal unit of scale here. Imagine handing an investor a report that says your assets are 3 pickup trucks and a small office building. That is totally useless for comparison. We have to translate all those random physical items into a common denominator, which for us is the US dollar.
Third, we have the periodicity assumption. Look, investors simply cannot wait until a company goes out of business 40 years from now just to find out if it ever made a profit. So we artificially chop the business's continuous life into neat periodic blocks of time. Think quarterly and annual reports, so we can give people timely updates.
And lastly, the going concern assumption. We essentially assume the business is going to live forever. This one is massive. Why? Because it's literally the only thing that justifies measuring our assets based on their original historical cost, rather than constantly marking them down to whatever scrap value they'd sell for in a panic liquidation tomorrow.
So, there you have it. You've learned the 2 key steps, measurement and communication. You've seen the underlying framework, and you've got those 4 bedrock assumptions down. It's time to step totally out of that intimidating math mindset. You've got the playbook now to start interpreting the business world all around you. So the only question left is, whose financial story are you going to translate first?